I don't believe it's a crowded trade yet, but there's certainly been a very large demand for yield, particularly with sovereign yields in the G3 in the developed world at record lows. And as many of you know, the Japanese yield curve is negative all the way out to almost 20 years, and similarly for Germany and Switzerland, I think, right, the entire curve. So that demand for yield is very, very compelling. In terms of value, I think there's some selective value in markets like Indonesia and India, perhaps from a carry trade perspective. But in my observation, the rally's been very, very defensively led. The fact that bond yields are still very, very low and falling is somewhat disconcerting, and some of the cyclical markets like banks have not performed particularly well, even in the rally or the recovery.
European banks, speaking of which, one of the things that really struck me while I was over in the UK is that post-Brexit, despite the stress tests, despite the capital rebuilding, etc., looking very, very vulnerable. Deutsche right now in particular. Do you roll the dice and buy some of these beaten down names, or do you not touch them with the proverbial barge pole?
I think they're very compelling from a long-term perspective. European banks are trading, some of the major ones you just mentioned, are trading at 0.2 times book value. So they're either very, very compelling value, or there is some sort of systemic issue. But I think the positive side is that they probably are, as a basket, in much better shape than they were prior to the crisis. So from that perspective, there probably is some value.
Can I talk about Japan and the currency? Would you be ill-advised to chase dollar-yen lower ahead of the Bank of Japan on July the 29th, especially when there is a non-negligible risk that they may go big, possibly even undertaking helicopter money? A lot of chatter about that at the moment.
Yeah. Well, I can tell you the two markets that we added last Friday on UK Independence Day were FTSE 100 and Japanese equity market. We did hedge the Japanese equity position. So I think Japan is, particularly into this episode, looking even more interesting now. I think the valuation's actually quite compelling, and the odds of a policy response by the Bank of Japan and probably the fiscal authorities as well is rather high.
But corporate Japan is still in a very, very rough place, isn't it? I mean, we can have big stimulus, aggressive stimulus from the BOJ, but wheels are falling off Abenomics. There's no guarantee that we're going to get to 2% inflation.
I actually think that's the really compelling part about Japan, that the corporate sector is actually in very, very good shape. And that, in some ways, that's actually part of the macro problem, that the corporate sector has the savings, which is not being transferred to wages and household incomes to an extent. So actually the corporate sector in Japan, on average, has got lower leverage than global equity markets, and profits are still relatively high. There's certainly been some significant downgrades more recently, and that may persist with the yen moving in the direction that it has, but it actually looks very, very compelling.